still have quite a few people still joining. I can tell by the webinar panel here. But nevertheless, I said this would be a short webinar, about 35, 45 minutes in length, and it will be recorded. So if you want to catch a replay of this webinar at a later date, I will post it on my blog, and we'll also post it on our website. It'll be probably be up tomorrow or the day after, so you can catch a replay if you have to leave early for any reason. But a little bit of background, why I decided to put this together. I've been following the SAFE Act and the Dodd-Frank Act since, for about 2.5, 3 years now, and I've received quite a few questions from existing clients or prospective clients that are investing in real estate, how this particular legislation impacts them. And when I first started following it, the SAFE Act really didn't concern me that much because I looked at it as a heavy-handed government regulation that is being imposed on individuals because the government initially screwed up and created this mortgage mess by allowing lenders to loan to people who otherwise would never have qualified. And so like anything the government does, they want to come back and rectify the problems they caused, and they come at it with a very heavy hand and just kind of throw everybody under the bus and treat us all as if we were the problem with the mortgage mess that we've experienced in the past several years. And so rather than, parse out those individuals who created the problem, say we're just going to deal with you in general, they enact this sweeping legislation that impacts everybody when it comes to selling property. And it's real important that you're on this call if you're investing in real estate and you're considering owner financing property, because the problems with these acts is that they impose some severe penalties if you're caught. And I'll go into those a little later towards the end of the presentation about what can happen to you in the event you're caught violating either of these massive pieces of legislation. But it's something that I can guarantee you wouldn't want to be on the receiving end of this stick, given what I've read thus far. So let's just get started. We'll start talking about what this act is and how it applies to you. So SAFE Act, what is it and why? Well, it came out of the Housing and Economic Recovery Act of 2008. And in fact, what it stands for is Secure and Fair Enforcement Mortgage Licensing Act. So that kind of gives us an idea right there what the target of this piece of the act was aimed at, and that is the people who write loans, mortgage loan originators. Now, the idea was by putting this legislation together is that the government was going to assist with the recovery of the housing market. And they thought one way to do that was to put together some legislation that ensured that individual homeowners, people who are wanting to buy houses, that they would be put into loans that would not end up in default. Forget about the fact that a lot of people lost their jobs and could no longer afford to pay their loan, but the government looked at it and said, well, if we had better loans out there, we did not have all those subprime loans that were being reset, and we had fixed rate loans, then we probably wouldn't have this problem. So they figured by instituting this act, it would solve many of the mortgage ills that have come up in the last several years. And the other idea was we wanted to enhance consumer protection, because a lot of the loan originators, people who are writing mortgages, the question was whose interest were they working in? Were they working in the borrower's best interest, or were they working in the loan originator's best interest and putting somebody into a loan? I can tell you from firsthand experience, back in 2006, we looked at entering into this market and creating our own mortgage department or company, separate company, and we ended up shutting it down and parting ways with an individual that we went into business with because of the practices that we saw that he was engaging in with the people that were working under him, the guys that were writing these loans. Basically what it came down to is this, that you could put somebody in a loan that would be a better loan for that individual in the long term as far as the amount of interest they paid, or you could ask them what payment they want. Many times people are more concerned about the payment and not the actual terms of the loan. And when properties are going up, you can see how that's, people don't care what the actual terms of the loan are because they figure they could always sell the property at a later date and get out of it in a rising market. Well, this individual that we were working with, he informed me and my other business partner that we could make a lot of money writing certain types of loans because the premiums were so much higher on specific loans. And essentially what you're doing is you're putting people into loans that was all interest, and that in turn gave a lot of money on the back end for the loan originator. And so you saw this problem starting to develop. We saw it developing in 2006, and we saw it was the area that we thought, well, we don't want to get involved in this because it might come back to bite us. But essentially, we saw what happened with the mortgage mess. People got stuck in loans that they didn't quite understand the terms, and as a result of that, they defaulted on their properties. So this act was targeted specifically, if you listen to some commentators, at those individuals. And the idea was that putting together an act where you require people who want to write mortgages to be licensed, then you're going to weed out some of this self-interest, and that is writing a loan where you're only going to make money off it, it's not in the best interest of the borrower. And so now they have what is state licensing for all mortgage loan originators. Anybody who is going to write a loan must be licensed. There's actually a federal database now of all of anybody that's writing loans, loan originators. They have to have a specific number. And you as a consumer can go to this database and look up information on a particular individual to see whether or not they've done anything wrong and they've stayed up to date. The idea, of course, again, like with anything, if you make somebody get licensed, you require that they obtain additional education, then they're going to make better loan officers. I mean, that's the intent behind the act, but we know, we have congressmen, we have attorneys, there are all kinds of people out there who have licenses, and doesn't do a darn bit of good for the general public. So that's the government's way of thinking. That's why this all came about. Now, what are some key components of the act which makes, from a seller standpoint, an investor in real estate, why does it apply to me? Well, this act applies to residential mortgage loans that are secured by an interest on a dwelling. That's one aspect of it. The other aspect is property use. So we're looking at, are you writing a loan that is going to be, you're financing a piece of property that the borrower is going to use as their personal residence. So if you sell property to somebody in which they intend to live in it and treat it as their personal residence, then you definitely fall under this act if you're trying to carry back the paper. Now, you also have down here business of loan origination. That's one other component, and that is if you are somebody who negotiates a loan, then you have to be licensed in your state, and you have to register with the nationwide mortgage license system and registry, that database I was referring to. So these are three components that apply to us as real estate investors, because when you sell a house to somebody, for example, if you're buying a property and an individual comes up to you and they want to purchase it from you, you're going to have to ask them what is their intent with the purchase of this property. If you know that they plan to live there and you're carrying back the paper, you're definitely going to fall under the SAFE Act when it comes to selling that property. And then if you negotiate the terms of the loan with the individual, that'll also throw you under the SAFE Act. So really what happens here is that they have us three ways when it comes to applying this act to us. So many people that have called me up and they said, Clint, I'm not a loan originator. Okay, so that shouldn't apply to me, that one element of the act. Well, if you read the act, what it states is that if you offer, negotiate a mortgage loan for compensation or gain, then it applies to you. Now, you may think when you read that should be interpreted as if you receive a commission for writing a loan. However, the act in the interpretation of it takes a different approach, is that if you benefit from writing that loan, be it through a commission or through the sale of your own property, because now you're receiving interest, because you have a vested interest in, maximize the interest rate that you can receive from this loan, you are a loan originator because there is compensation to you. It's just not in the form of compensation in the traditional sense where loan originators receive a commission for the sale of each loan that they write. So if you take a residential mortgage application, okay, you're considered to be a loan originator, or if you negotiate the terms, okay, or if you assist a person in obtaining the mortgage loan. So these are all elements of what it takes to be a loan originator. And if you fall within any of these, you're definitely falling within the SAFE Act. And that's why when I sent out the email, I said, you know, it's the death of seller financing. Obviously, if you are buying and selling property, which many people on this call are doing, you buy a foreclosure and you turn it around and you flip that property to an individual. If you're negotiating that sale, you're definitely going to fall under the Act as a loan originator. Okay, so what is required? Now, why is this important to be a loan originator? Because right now, the way it stands under the SAFE Act, if you want to sell property and seller finance it, and you're going to put together the loan, you have to become a mortgage loan originator. So if you're going to go out there and sell to individuals who are going to treat these properties as their personal residences, you're going to need to get licensed. And now I'm going to go into in a little bit, you know, some exceptions to this rule when it doesn't apply to you. But think of it this way, is that if you're planning on turning 15, or actually 10, 15, 20 properties a year, you're definitely going to be licensed. You have to be licensed in every state where you sell property. It's not one of those areas where you can be licensed in one state and then that carries over to the other state. When it comes to being a mortgage loan originator, when you're selling real estate, every state where you do business requires licensing, and with that requires mandatory continuing education, testing. They're going to run your credit report. And I've had some people call me up and they say, well, Clint, I know a way around that. I'm going to have somebody that works for me who is licensed. I'm going to send out one of my employees, get him licensed, and we'll have him work under a limited liability company that I've set up, and we'll sell properties out of this LLC. Because as long as we have that one person's license there hanging on the LLC, then I can go out there and continue to do what I do. The problem with the Act is that it specifically excludes companies or businesses. It states that any person that deals with an individual has to be licensed. So you can't get around the Act by creating an entity and having the entity licensed, or having an individual within that entity licensed, and then everybody who works for the entity is now covered. This Act is very specific when it comes to this. It requires that each individual who deals with a borrower be licensed under the Act. All right, so prohibitions. So what does this bring us down to? Well, here's what's prohibited. Seller financing the sale of residential property, okay, to an individual who's going to treat the property as their residence. Now, seller financing includes, of course, purchase money mortgages or land contracts. There was some concern whether or not land contracts would apply. It does apply under the SAFE Act. For those of you who are not aware what a land contract is, unlike a traditional mortgage, a land contract is an agreement where the buyer continues to pay you under the agreement until such time where the property is paid off, then title is transferred. So it's not like a mortgage. It's a little different than that under a land contract, but it's still, the Act will still apply. Now, lease options, I know a lot of people are into lease options. That is not covered in this Act. Lease options are fine. Now, if they look like a mortgage, a purchase money mortgage, or a land contract, then you may have a problem with your lease options. So that's something you have to be aware of if you're someone who likes to write lease options that have maybe a dollar buyout or something like that at the end of the term. That looks like a mortgage. And if it was called into question, I'm pretty sure that it would be viewed as such. So you cannot just throw a term on your agreement and think that you're exempt from the Act, because they're going to look at the substance of the transaction over the form of the transaction. Now, this applies to residential property. Now, if you sell land to someone who's going to use that property to build their personal residence and you sell or finance it, this Act applies to you as well. So you will fall under the SAFE Act. You're selling land. Now, if you provide financing for properties you don't own, you know, that's pretty straightforward. If you negotiate a loan for somebody else, okay, the Act's going to apply to you as well. So what they're really trying to protect are individuals from getting into properties that they cannot afford, of course, which they treat as their personal residences, because we want to keep people in homes There's a strong reason for that, home ownership that is. And so the Act was designed to ensure that there is not unscrupulous lending when it comes to financing individuals who are buying a house for their personal use. Now, the prohibitions are there, but there are some exemptions to this Act. So, as long as you're not selling property to someone who is going to use the house or the land for their personal residence, then the Act is not going to apply to you. That is, if you're selling it to other investors. If you're selling your personal residence or a secondary home, the Act does not apply to those types of sales. You can sell or finance your personal residence or a secondary residence, no problem. The Act won't apply. They give you that exemption. If you're selling commercial property, okay, or a quad, those types of units, then even if the individual who is buying it from you, if it was a sixplex and the person that you're selling it to has informed you that they intend to live in one of the units, it's still classified as commercial property and the SAFE Act will not apply. But if you're selling somebody a duplex or a quad, anything 4 and under, and you know that they're going to live there, the intent was they're going to treat one of those units as their personal residence, then you definitely fall under the SAFE Act, and per the original Act, you're going to have to be licensed. Property that's sold to a developer, okay, that's not a problem. You don't have to get licensed in that situation. And if any loans are made for financing for business purposes. So essentially, as long as you can show that the sale was for something other than a personal residence, you're not going to fall under the SAFE Act if you're seller financing that deal. So the SAFE Act, again, as we stated, it's really designed to address the personal residence issue that came up with people losing their homes. Now, the SAFE Act itself is controlled by HUD. When they put this together, they said we have to have some governmental body, some organization establish regulations for this Act. And so they turned that over to HUD to interpret the SAFE Act. Now, when the SAFE Act came out, it stated that every state had to adopt the SAFE Act or their own version of it, and it had to comply with the federal act. Now, this created quite a problem for many individual investors because some states allowed you to sell a few properties and you would be exempt from the SAFE Act. Some stated you couldn't sell any. It automatically applied to you. And so there's been a bit of a patchwork now of different requirements throughout all 50 states depending on the legislature that has adopted this act. And the problem that everybody came up with, or that they're running up against, is the fact that there wasn't any clearly defined regulations. I know over the last year and a half, HUD's been throwing out a few thoughts or interpretations of the SAFE Act, but nothing that anybody could rely upon. And this created even more confusion in the marketplace when it came to seller financing. Because, I mean, the problem with these acts is that it really it freezes out a lot of people out of the market, because when you were dealing with these smaller homes, the $40,000 and $50,000 properties, especially down in certain southern states, or actually even in some West Coast states, the buyers oftentimes have a hard time obtaining financing for them, just because of the fact that banks are often unwilling to loan on a $40,000 home. They're going to have to come up with the cash, and many individuals that are in that circumstance do not have $40,000 to buy the house, so you have to seller finance. Otherwise, these people cannot afford to get into these homes. So states have recognized that based upon their own populace, their own properties, and so they started to formulate some of their own interpretations of the Act. However, it was all subject to HUD. Now, HUD issued the final rule here on June 30th of 2011. And when they came out with this final rule, this is the final interpretation of the SAFE Act that individuals and states can rely upon in finalizing their own acts. And what is important here is that what HUD did in this legislation, or this regulation, is they distinguish between the business of a loan originator and one who is simply offering seller financing. Because HUD was inundated with investors comments on the SAFE Act, basically saying, listen, I'm not in the business of financing or mortgage loan origination. I'm just a real estate investor who's trying to put people into property. And as the SAFE Act currently stands, you're going to penalize me for selling somebody a house and carrying back the paper. I'm not the so-called bad guy that went out there and securitized all these mortgages and created this mess that we're in. So HUD took all that under advisement, and they did what most governmental agencies do when they issue out regulations, is that they left themselves a lot of wiggle room in this legislation. They did not give us clearly defined terms. What they essentially did is allowed us to interpret how we think the SAFE Act should apply to us as of June 30th, 2011. So what they did is they broke it down into 3 different categories. They said business of a loan originator. Okay, anybody who is, as we would call a mortgage loan officer, they engage in the business with a commercial intent. You know, that is their occupation. That's how they derive their livelihood. It is from writing loans. Okay, you have to be licensed. There's no question in their mind and in mine that you're in the business of loan origination. Therefore, you're a person to whom the SAFE Act definitely applies, because we're trying to regulate your activity. We want to ensure that you're not putting people into mortgages that they can't afford, or it's based purely on personal financial reasons why they're in there. Now, they did address the individual residence seller. And they said individual selling his own residence, vacation property, or inherited property, because this was not covered in the original act. This was HUD's interpretation, because a lot of complaints stem from the fact that if I inherited let's say my parents' house, my parents passed away, inherit their house, and I turn around and I want to sell it to a family member, or I wanted to sell it to somebody else, all of a sudden now I could not sell or finance that property. Well, HUD said that you can include inherited property as well as your vacation property, and you're not considered to be in the business of loan as a loan originator, and that activity is exempt. So you can sell those types of properties, sell or finance them all day long, and you're okay. You don't have to be licensed. Now, the big one that my clients are very concerned about is, what about the investor? Okay. Now, here's where it becomes a bit confusing. And it's because HUD did not want to give us some bright line rules. What they wanted to state is come up with some interesting words such as habitualness and a commercial context. So as long as the activity does not reflect that or rise to the level of that, then you would not have to be licensed as a loan originator under the SAFE Act. So what does this mean? Well, if I have a bunch of property that I'm looking to sell, what I gather from this language is that HUD's going to look at my overall activity and say, how many properties are you selling a year? Okay, are you doing this in a commercial context and such that you're buying massive amounts of homes, you're turning around and selling them to the public, and you're carrying back all these notes? Anywhere between, after 15, 20, 30 properties, does that appear as if it's more of a commercial endeavor versus the individual investor who's buying maybe 1 or 2 homes a month and selling that many? I would say so, and that's what they would look at in determining whether or not you're a loan originator. Now, if you sold 50 homes a month, but you only sell or financed 15 of them, should the SAFE Act apply to you? I think that is more of a gray area there as to whether or not this act would apply in your situation, because definitely you fall within a commercial context, that is, you're selling property. But when we look at the scope of the sales in general versus those that are seller finance, we'll find that the bulk of them are through traditional financing methods where you've used a loan originator, and a small portion you've seller financed. So these are areas, again, where we don't have really any clear line rules. HUD did, though, open it up to us. So essentially what they said is they'll probably take it on a case-by-case basis. And as an individual investor, what that means to me is that if I think that I'm getting close to that line because I'm writing quite a few seller finance deals, I would say at least if I'm doing 4 a month, then you're probably going to want to get licensed, or you're going to want to use a a licensed originator to handle these loans with the people that you're dealing with. And that's the problem with that, as you know, as an investor, that's just more money out of your pocket to go out there and deal with a mortgage broker to help facilitate that loan. But again, it's within the scope, the intent of the act is to ensure that the person who's buying that property is, not getting the short end of the stick here because they're unsophisticated, they don't understand what it is that they're getting into. So this was HUD's view of the act, the regulation as of June 30th, 2011. Now this now applies to everyone because HUD was charged with overseeing this act. So that's where we're at as of now when it comes to the SAFE Act. So what does that really mean in the grand scheme of things? Unfortunately, this has received the most attention when people call me up. They're all concerned about the SAFE Act. What they don't understand, and many people do not understand, that's why I wanted to put on this short webinar tonight, is that it's the Dodd-Frank Act, which is the devil in this mix. This piece of legislation right here is the one that everyone needs to be concerned about. And, again, you see Barney Frank, he was one of the individuals with Chris Dodd who put this act together. And what's ironic about it is that the problem that the whole mortgage crisis, a lot of it stemmed from Barney Frank's actions back in 2003 and 2004, where he was forcing Fannie Mae, Freddie Mac, and the banking industry to make loans to people who could never qualify under traditional finance. And he said that they were not helping enough people get homes and they had to relax their standards for loans. Well, we saw what resulted from that, and so now he came back with a hammer and he's going to try to fix it with this massive piece of legislation that was adopted last year. Now, the Dodd-Frank Act, what is the implications, what is its history? Well, Dodd-Frank Act was, as I stated, was enacted after the SAFE Act. So the SAFE Act was the first person at the party. Dodd-Frank came after the fact. Now, what Dodd-Frank does is it impacts the SAFE Act. So under Dodd-Frank, there, of course, we have the whole issue with the mortgage originators and promoters of loans, and they're dealing with the same thing that SAFE Act does. The SAFE Act was kind of like a temporary act that was put into place until this piece of legislation could be moved through the Senate. It is actually taking away oversight from HUD and moving it to the Consumer Finance Protection Bureau. And that's going to take place on January 21st of 2013. That's when this act or portion of the act actually goes into effect. And it affects you as a real estate investor if you're going to sell or finance property. See, under the Dodd-Frank Act, they don't mess around with the language that HUD's using about habitualness and in a commercial context. They came out and they said, we're not going to concern ourselves with a personal, if it's your personal residence, or if it's inherited property, vacation property. We're going to tell you this: you can't sell more than 3 properties a year and sell or finance them to an individual who is going to treat that property as their personal residence. So if you're going to sell or finance, they put out some criteria here. Okay, seller did not construct the home. Okay, that's one thing. So you can't build the home and then sell it to somebody and try to sell or finance it. That will not work. The loan must be fully amortizing, no balloon mortgages. Now this is a huge problem for people who are seller financing. Most investors, when you sell or finance, you want to set up a mortgage. Typically, a lot of times it's an interest-only mortgage because people cannot afford to pay out the house in 5 years. You don't want to be in a loan in 5 years, so you're not going to put together a 5-year fully amortizing loan because the payments would be too high. You do not want to, that is, when I say you as the real estate investor, you do not want to assume the mortgage risk or the interest rate risk, because if you have a fixed rate at what the current rate is right now, 4%, 3.5%, and 2 years from now the interest rates jump up to 14, you're stuck if that's a fixed rate mortgage. But for big banks, this doesn't matter, and this is a problem with this legislation that, from my point of view, is that it doesn't take into account that the individual real estate investor does not have the same ability to manage their risk that a commercial lending institution has. And that is, when a commercial lending institution writes a mortgage, it turns around and sells that mortgage off, and it gets back its money, so it can go out there and continue to engage in these types of transactions. Whereas you, as the individual real estate investor, you don't have that market that you can bundle your mortgages up and sell them to minimize your risk exposure to inflation and upwards pressure. So you're stuck essentially under the Dodd-Frank Act when you put together a note and you're financing the property, because it must be fully amortizing. So what's going to happen is that you're going to end up putting together a note that is going to be maybe a 30-year am with a 5-year balloon at whatever the current interest rate is. And so for 5 years, you know that you're only going to receive, if we did it, say we wrote one today, I'm only going to receive 4% on my loan amount. That's all I can take or receive, because that's what the current interest rate is. I can't increase it, okay, beyond what is reasonable in the marketplace. It has to be consistent with the marketplace. So I'm stuck offering a loan at the same rates that the local bank is. I can't look at the individual and say, well, you know, we're going to increase it to 9%. That would not fly under Dodd-Frank. Now, in 5 years, you can go back with a balloon and have them refinance out and use a bank and pay you off, or you'll have to deal with them at that point in time. And again, you're still going to be stuck with these rules, that it be a fully amortizing loan with a fixed rate. Now, something that should be a concern to you as well is that these acts apply not only to loans that you're going to be writing in the future if you're seller financing property, but any loans that you currently have. If you have some people that you're carrying the paper on right now, and you have a balloon payment set up on those properties, when that loan comes due, when you renegotiate that loan, if you're going to carry the paper again, you will fall under these acts. So they not only pick up the new loans that you're writing, but they also pick up any pre-existing loans that you've written in the past that are about to mature. So you're not going to get out of it with anything that you're currently carrying. So this last portion on here, the last point, you know, loan meets other criteria set by the Federal Reserve Board. That's kind of scary to me. Again, what it's stating is that they're giving the Federal Reserve Board the ability to change the playing field as we go along. One of the areas that we often talk about in our workshops, you know, when it comes to corporations and LLCs, is that the law is very static there, that as a business owner or somebody who's looking for asset protection, we know what types of benefits are provided to us, so we can rely upon that in making our decision. Under Dodd-Frank, with this loan meets other criteria clause, it really doesn't give me a lot of comfort when I look at that, and knowing that the loan that I write with somebody may or will always be interpreted as provided for under the Dodd-Frank Act, because they could change this at any time. So that's a real problem in my point of view under Dodd-Frank. Now, does not violate. Here's the problem. Do not violate this act. This act has severe penalties in it. They have civil penalties of up to $1 million a day. That doesn't mean that it would apply to you if you violated and you were seller financing, say you seller financed 6 properties in a year. That doesn't necessarily mean that you'd be hit with that type of penalty if you were caught, but it's provided for under the act. So it's something that, you know, you have to understand that they issued a statement when they put this act out that they will enforce it to the best of their ability, and they're going to be very aggressive in their enforcement of this act once it goes into effect. So they're setting a signal basically to the mortgage industry is, don't screw around, because we're not going to deal with you the same way we dealt with you after the original mortgage mess, is that now the rules have changed. Well, you know, and throwing this out there, they've also picked up us little guys who weren't the ones out there writing the bad loans, but again, the penalties apply to us. Other things to consider with this act that I think would be of particular importance to any investor is the ability for a buyer to get out of an agreement, the purchase of property, if you're found to have violated the Dodd-Frank Act. Essentially, I mean, I can think of it if I was representing somebody who was a distressed homeowner and just wanted out of the agreement that they were in without any penalties. I would try to determine if you, as a real estate investor, had sold more than 3 properties within that year and carried back the paper. And if so, then I would move to have the contract rescinded as a violation of the Dodd-Frank Act that my client, of course, didn't receive adequate notice. And I'd also, probably seek refunds of any payments made by my client and/or restitution in addition to that. So you can see that there'll be some problems here. If you wanted to foreclose on somebody that you had sold a house to, and if it's found out through discovery that this was the 5th property you sold that year, okay, there would be problems there. It could complicate your foreclosure. Who knows how a bank might interpret that? We saw what's gone on with some of these mortgages recently, where the banks were forced to just write off the amount altogether, and the homeowner got to keep the house free and clear of any existing mortgage. Now, that doesn't necessarily mean this would apply in your particular situation if this ever came up, but it's something that you need to be aware of, that Dodd-Frank does impose some severe restrictions if you violate this act. Now, why is it so problematic? Well, it regulates the sale of a personal residence. Under the SAFE Act, you could sell your personal residence, as I stated, and it didn't matter. Under the Dodd-Frank Act, it applies. Okay, it applies to sales of all properties somebody's going to move into and treat as their own personal dwelling. As I stated, it places the inflation risk on you. Okay, because of the fact that you have to put together a fully amortizing loan. Yeah, I put in here, 30-year amortizing loans only exist because of government support. Absolutely, I believe that a bank or any lender would not be in the position of wanting to write 15 and 30-year amortizing loans if you didn't have the government propping up the mortgage market with Fannie Mae and Freddie Mac by buying these, by allowing them to sell it off to somebody else, because there's just too much risk there with inflation for the banks to want to take on. So that's a problem we as lenders. We don't have that outlet, so we have to eat that. And as I stated earlier, it could have a major impact on the sale of homes under $40K for those people who buy homes in that price range under $40,000. I myself invest in properties under the $50,000 range. And when it comes to selling those to a homeowner, if they don't have the cash or they can't get a loan for it because banks are just unwilling to lend, you may find you're going to be stuck with a lot more rentals now under Dodd-Frank than you had anticipated, because it only limits you to the sale of 3 properties a year. Now, just like with the SAFE Act, we have exemptions. Okay, what I would strongly encourage you to do to comply with Dodd-Frank when you're seller financing property, if you know, or first off, you should ask the buyer if they intend to treat it as a dwelling. If they're going to treat it as their dwelling, we know this applies. If they state no, that they intend to treat it as a rental, then you should have them certify in the agreement or in a separate writing that they do not intend to utilize that property for personal or household purposes, i.e. that's not going to be a dwelling for them. And I'd also make sure that they have a separate dwelling, and you should certify the address for them. Have them certify the address of their other dwelling, how long they've lived there. Do some due diligence on your own. Now, if you really want to solve the issue altogether, any investor that's buying your property from you, if you're concerned that they may be telling you this just to get you to carry the paper for them so they don't have to go through traditional financing, have them form a limited liability company or some other entity. I wouldn't necessarily use a land trust in this situation because of Garn-St. Germain Act, and they could just be looked at as a fully pass-through to them. I would ask them to form either a corporation, limited liability company, or limited partnership, and only close in the name of that entity, or else maybe you put the property into an LLC and then you sell them the limited liability company. You don't sell them the property outright. So what we're attempting to do in this situation is establish that this is a commercial transaction, or it's sold to an investor, and it was never intended that it be structured as a personal residence or sold as a dwelling to an individual home buyer. Land does appear to be exempt under the Dodd-Frank. However, Again, this is something that the Federal Reserve Board may rule on later. You know, there's a question as to whether or not you build property or sell property to an individual, land to an individual, and they intend to construct their personal residence on it, and you carry back the note on the sale of that land, knowing full well that they will build a dwelling, you know, their personal residence on that property. To be on the safe side, if that case came up or if you came to me with that situation, I would tell you that you probably treat it as one of your three for the year, given the fact that there really isn't guidance on that yet. Or else, you know, set it up in an LLC and go through the certification process and sell them a limited liability company and carry back the note on that. That'd be another way to handle that one. But that's still up in the air. So if we're going to reconcile these acts, here's what we know today. You sell your residence under the SAFE Act, that is an exempt transaction. Under Dodd-Frank, it's not exempt. It applies to their three-property rule. Under SAFE Act, you know, you don't have to be a licensed originator to sell your own personal residence or vacation property or secondary residence. If you're selling commercial property or investment property to an investor, under both acts, that's clear. That is exempt. You can carry back the paper in those types of transactions. You're going to be safe there. Adjustable rate mortgages. Well, Dodd-Frank regulates the actual agreement, the financing agreement between you and the buyer. The SAFE Act does not regulate it. Dodd-Frank does. So it's not permitted under Dodd-Frank. Future modifications of existing agreements are both covered under both these acts when the balloon comes about. Sale of land, I had that one backwards. It should say Dodd-Frank, depends, SAFE Act, could be exempt. Well, again, just think of it this way. As long as the land's not being sold for personal residence, you're going to be okay. If it's sold for a personal residence, then it's not exempt under the SAFE Act, and under Dodd-Frank, it's probably not exempt under that either. For the sale of land, it's going to be treated as a personal residence. If you sell more than three in 1 year under the SAFE Act, you're okay. You can sell or finance more than 3 properties in 1 year to a buyer who intends to treat it as their primary residence, so long it's not habitual in this commercial context area. So what does that tell us? Well, we know we can sell more than 3. But how many can we sell in a year? Well, that's left to interpretation. What is your gut feeling? Under Dodd-Frank, it's crystal clear. The answer is no. But if we reconcile these, what it tells us is that in 2013, Dodd-Frank will trump the SAFE Act, and you're going to fall under Dodd-Frank when it comes to selling real estate. So you have a window of opportunity here, if you want to look at it from that context, that Dodd-Frank won't kick in until January of 2013. So until then, we're operating with this temporary SAFE Act in place, and then everything's going to switch away from HUD and over to the CFB under Dodd-Frank, and then we're going to be following their regulations. So it's something that I think you need to be aware of going forwards with selling real estate. There's been a lot of misinformation out there on the internet, a lot of people speculating as to how these apply, but HUD really cleared it up for us this year, and Dodd-Frank, you know, the statute or the act, I think, is a little cleaner from the standpoint it's by laying out what you can and cannot do by drawing some clear lines. So those are the 2 acts that I wanted to cover tonight. Those are the issues that we're going to be up against as investors if we want to carry back the paper. I got a few more things here. For those of you that didn't know about it, I am teaching a 2-day real estate workshop in Chicago on October 1st and 2nd, coming up here in a couple weeks. Those of you in the area, if you'd like to attend, it's $99 if you're on this call tonight. Just put in the word SAFE. You can go to our website and sign up for it. Many of you have been to our workshops before. We've totally revamped our asset protection workshop that we've taught in the past. Those of you who've attended it through Rich Dad Education or through one of the other companies that we work with. And I'm real excited to get out there and teach this new class. If you're going to sign up for it, if you're interested, I'm going to hold this open for 2 days at the $99 rate. You can go right to our website. I've shown you here how you can sign up for it. You just down on the bottom right-hand side of the website there, it says Chicago, Illinois, October 1st. If you click on the October 1st, it will take you to this page right here, and it says $6.95, but if you click on enroll, a lot of times people get confused here. You just click enroll, and it'll bring you to another page, and you can invite a guest for sure. Put in safe on the coupon code, and then click submit, that button right below it, and it'll reduce that price down to $99 for you on checkout. And for those of you who want to know about the class, we'll be teaching other ones in different areas of the country going forwards. I just want to show you what the new agenda looks like for those of you who've been to our class before, those of you who are considering attending one of our workshops. The workshop is designed to put together, show you how business entities work from a real estate investor's standpoint with the new changes, for example, the SAFE Act, Dodd-Frank, and the complications that they present to you as an individual investor. And so with the new agenda now, we're going to go through some of we're talking about the most recent threats and trends that we see in the industry, and throw in a bunch of case studies to show you how investors, they got caught up either with governmental regulations or things that they did that brought liability to them, and how they could have fixed it if they set it up a little different way. And we're going to talk about some of the design flaws, because I know a lot of people on this call may already have limited liability companies in place. We're going to show you where the issues lie in those operating agreements from our own personal standpoint, from reading cases where LLCs have been pierced, talking about some of the recent law changes that are out there with respect to LLCs. Nevada just recently changed their statute. I don't know if you read my blog on that. It goes into effect here in October, but they really strengthened their statute. And that was in response to what happened in Florida last year. They went and they looked at their statute and said, could we make it better? And they definitely did. So we'll be talking, we'll be discussing LLCs and how they work and how they should be structured, especially when dealing with banks and insurance and title companies. In my own investing, I've come across this in the last year and a half, putting together short sales, dealing with these when you're buying through a limited liability company. So we're going to be sharing with you some ways to navigate that issue. Purchasing foreclosure properties, there's federal legislation out there that affects that, and what you need to look out for if you're going to buy foreclosures, what the landmines are, so you don't buy a property and find that you've lost it now after you've taken titles, that you start to put some improvements because there was some problem in the foreclosure process that holds you as the investor responsible for it, that is, you lose your investment or that property. So we'll be going through a section on foreclosure investing. We're going to talk about some, of course, real estate corporations, understanding the best type to use for your investing and choosing the right state. That's, for those of you that haven't formed a corporation, we'll be throwing out some different strategies as far as how to change your income through a corporation. A lot of people we've told in the past, when you're investing through a corporation, if you're buying and selling property short term, that's the way to go, especially if you have expenses that you're looking to deduct. Well, there comes a time when, in my opinion, that the corporation, it no longer makes sense to be earning too much money in a corporation, because now we're trying to find ways to expense it all out, and there's only so much you want to buy, and now you want to start saving money. So we'll show you how to couple that with a limited partnership where you're investing to keep you down in the lower tax brackets, but change the overall look of the investment itself from a tax standpoint. Asset protection will be the same, but it's a little different take on the traditional just investing through a corp. And then we're going to go through real estate contracts. We've seen a lot of problems with this lately, where people have put together real estate contracts and they've missed some issues in there. So we're going to go through from a legal standpoint, especially when dealing with LLCs and trusts, buying property there. That's important that you understand the distinction in putting those together. We'll talk a little bit about tax-deferred investing through IRAs and the issues that we've seen over the past year and a half. This is one area the IRS is focusing on. You better be up on it if you want to invest in tax-deferred accounts, and we'll show you how to set up an alternative to that through a pension. And then it goes from the land trust. We'll also talk about short sales with HAFA and how that applies. Personally, I've been investing in short sales now in the Las Vegas market, and one of the things that comes down to short sale, especially if you find the individual that's in the distressed situation that's looking to put together a short sale. That is, how do you get it past the lender so they're willing to sign off on it? So we have a section devoted to this where we'll be talking about how things that should go into the short sale agreement, things that you're going to want the lender to see that may help expedite the process so you can acquire this property. Because I know, a lot of my properties, when we're dealing with the short sales, because we don't have the time to go out there and find the distressed homeowners, we're actually picking them up as soon as they hit the MLS. And so in that time, it's already been accepted, but we're not getting the prices that we would like necessarily because they've already gone through the process. But if you can get them on the front end and you can get the lender to sign off on it, you make it something that's palatable to them, that can really increase your return on your investment. So we have something devoted to that. And then we'll talk about a wealth preservation trust and how that ties everything together. So that's our 2-day event that's coming up. It'll be in Chicago, as I stated, on October 1st and 2nd. We've got space for another 20 people in that event, and then we will be rolling that out again through some other areas of the country throughout the remainder of the year. So if you're interested, check it out on the website. I hope tonight that this kind of cleared up many of the issues surrounding what you've been reading about seller financing. Just understand that right now we're under the SAFE Act. It's not as stringent as what most people thought when it first came out, and they've been talking about in the last couple of years since HUD issued their final regulations here in June. However, whatever you take away from this, come 2013, Dodd-Frank's going to step on the SAFE Act and squash it like a bug, and that's what you're going to be dealing with in another year and a half. And so just get ready for it and know what is out there and plan accordingly. As always, I wish you the best in your investing. As I stated earlier, I'm going to have this recording of this up on my blog tomorrow and on our website if you want to review it or pass along this information to your friends. All right, I wish you all the best again this evening. Take care, and that's all I have.